So, a war thousands of miles away could raise mortgage payments for over 1 million Canadians this year. And it's already starting. And if you've checked your mortgage rates recently, or maybe even opened up your banking app, you may have noticed something interesting. After months of stabilization, some lenders are starting to move rates higher again. But see, here's the part almost nobody is talking about yet. Canada is actually more exposed to global shocks like this than the United States. And I'll explain why in a minute, because the reason mortgage rates are moving has very little to do with the housing market itself. It has to do with the global economics. And the conflict involving Iran is already shaking the markets that influence Canadian mortgage rates. And take a look at this report from Global News Toronto.
A million households are set to renew their mortgage this year, according to the CMHC, Canada's national housing agency. And the Iran war, along with the changing rhetoric around it, are causing big changes to mortgage rates.
We've seen bond yields really spike up in the last few days, although it's like a roller coaster. Every tweet seems to move things.
Fixed rate mortgages are based on Canadian government bond yields, which move in lockstep with the broader bond market.
We've probably seen fixed rates go up by at least a quarter percent, kind of right across the board from all the lenders.
Investors are nervous about the spike in energy prices, even though the International Energy Agency, the IEA, is set to release a record 400 million barrels of oil reserves in an effort to stabilize crude prices.
High oil prices leads to inflation, which leads to higher prime rates, which leads to higher mortgage rates.
But reserves are limited, and if the war persists, this unprecedented emergency measure can only do so much.
And that report highlights something most Canadians don't even realize. Mortgage rates don't just move because of housing supply or local demand. They move because of global financial forces like oil prices, inflation expectations, and bond markets. And after working in real estate for over 20 years, I can tell you this is exactly how global events quietly start influencing mortgage markets before most people even notice. So let's walk through the chain reaction economists are now watching. First, conflict in major oil producing regions affect energy markets. The Middle East plays a huge role in global oil supply, and one of the most important transit routes in the world is the Strait of Hormuz. Roughly 20% of the global oil supply moves through that very narrow passage. So when tensions rise there, even the possibility of disruption can send oil prices higher almost immediately. And oil prices affect far more than just gasoline. When energy costs rise, transportation costs increase. That affects your trucking, your shipping, your agriculture, your manufacturing, and even construction materials. So eventually those higher costs filter into the prices consumers ultimately pay. And that's how energy shocks feed into inflation. And one important detail economists point out is that this inflation impact doesn't always show up immediately. Energy price spikes can take months to work their way through the broader economy as supply chains adjust and businesses gradually raise their prices. But financial markets don't wait for inflation to appear on financial reports. Investors react to the expectation of inflation. So when investors expect higher inflation, they demand higher returns on government bonds. And that's where mortgage rates come into the picture. In Canada, fixed mortgage rates are closely tied to the Government of Canada bond yields, particularly the 5-year bond yield. So when those yields rise, lenders often raise their mortgage rates as well, and fixed rate mortgages have already increased by roughly 0.25% across several lenders as markets react to rising energy prices and the uncertainty. Now, 0.25% may not sound dramatic at first, but from what we're seeing right now with lenders and renewals, even a small move like this can quickly translate into real monthly costs for homeowners. And this is where the Canadian story becomes really important. Earlier, I mentioned that Canada is more exposed to global shocks than the United States. And here is why. In the United States, most homeowners lock in their mortgage rate for 30 years. Once they sign their mortgage, their interest rate stays the same for decades, regardless of what happens in the global markets. Canada works differently. Most Canadian mortgages are structured with terms of 3 to 5 years, even though a full amortization might be 25 or 30 years. That means Homeowners regularly renew their mortgage at whatever rates exist in the market at that time. So technically, the longest common fixed rate mortgage term offered by major Canadian lenders is usually around 10 years. But most borrowers don't choose that option because the interest rates are typically higher and the penalties for breaking the mortgage early can be quite significant. So in practice, most Canadians are renewing mortgages every 3 to 5 years, and that means global financial changes reach Canadian homeowners much faster. If bond markets shift today, that shift can show up in a renewal quotes within months. And that's exactly why this year matters. And according to CMHC, more than 1 million Canadian households are scheduled to renew their mortgages in 2026. And many of those mortgages were originally signed during those ultra low interest rates periods between 2020 and 2021, when some borrowers secured rates close to 2%. Now they're approaching renewal in a very different interest rate environment. And in conversations we're having with homeowners right now, the biggest emotion we're seeing is anxiety. People are looking at their renewal quotes and realizing their mortgage payment could be 30 to 50% higher than what they're currently paying. And for some families, that might be manageable. Mind you, they may have to do some budget cuts. But for others, it's extremely stressful, especially if they're already dealing with higher grocery prices, higher utilities, and overall higher living costs. Some homeowners have been relying on their credit cards and their lines of credits just to keep up with monthly expenses. And that means they're already feeling financially stretched even before that renewal even arrives. And in some cases, their credit has deteriorated because of that pressure. And when your credit score drops, your mortgage options have become more limited and potentially more expensive. So in some situations, homeowners may have to make difficult choices. They might have to refinance, they might have to downsize, adjust their spending, or in some cases, sell the home. We're also starting to see early signs of financial stress showing up in the data as well. Mortgage delinquency rates in Canada have been rising since interest rates began climbing in 2022. And in some major markets like Toronto, they've reached levels not seen in more than 10 years. Now, it's important to keep that into perspective. Canada's overall mortgage delinquency rate is relatively low compared to many other countries, but the trend is something economists are watching very closely, especially with the large mortgage renewal wave expected between now and through 2027. Now, this is one of the reasons why housing inventory has increased across the Ontario market over the past few years. Active listings have risen well above extremely tight conditions we saw during the pandemic housing boom in 2021 and 2022. In fact, housing inventory across Ontario recently sat more than 40% above the 5-year average and over 50% above the 10-year average for this time of the year. Months of inventory have also moved into a more balanced or buyer-leaning market, sitting around 5 to 6 months of supply in many areas. So the housing market today looks very different from the ultra-tight conditions of just a few years ago. So what happens next? Well, if you want me to be completely honest, nobody can predict this perfectly. But based on what economists and lenders are saying right now, there are two main possibilities. If tensions ease and energy markets stabilize, oil prices could settle down. That would reduce inflation concerns and allow bond yields to stabilize as well. So in that case, mortgage rates could level off again. But if tensions continue and energy markets remain volatile, inflation expectations could stay elevated. That would keep pressure on bond yields and potentially keep mortgage rates somewhat higher than they might otherwise have been. For Canadians renewing their mortgages this year, preparation is key. If you're renewing your mortgage in 2026, start looking at your options earlier than you normally would. Waiting until the last minute is one of the biggest mistakes homeowners make. And take the time now to assess your housing situation and your mortgage options. And you need to mentally prepare yourself for the choices you may need to make, because the worst financial decisions people make are often the ones made under duress and pressure. And if you prepare early, you give yourself time to explore options and make decisions calmly instead of reacting to a deadline. The conflict itself may be happening thousands of miles away, but the ripple effects can still reach Canadian households. Oil prices influence inflation, inflation expectations influence bond markets, and bond markets influence mortgage rates. With more than 1 million Canadians renewing their mortgages this year, even modest shifts in those global forces can affect household budgets. But before I wrap up, I'm just curious about something. If you're renewing your mortgage in the next year or two, would a higher rate actually change your plans? Would you stay put longer? Would you sell or adjust your budget? Because sometimes the biggest change to your mortgage payment doesn't start in Canada at all. Sometimes it starts halfway across the world. Anyways, thanks for watching, guys, and I'll see you in the next one.